Hello, Anthony.
Hey,
Hey, how are you today? How are you? Look like it's just us today.
yeah, just us. It's all right though. It's all right. I think it's a good thing. Sometimes, it's just how it's supposed to be.
Yeah. I'm gonna miss my girls. Don't miss my
I'm
girls.
gonna miss them. I'm gonna miss them.
So, hello, everybody. This is Mad Flow in the house. Mad Flow. I'm not crazy, but I am mad about making a difference for life and others through financial literacy. And that's what we do every Friday. Me and my partner, Anthony Murray. We also usually have Tanya Pilcher Scott on the show with us and Renetta Gardner. We're going to miss them today. We're going to have a great show. We got a great guest for you. So everyone tune in 1 o'clock every Friday, ATR Financial Sins. And I'm gonna turn it over to Murray. Anthony, let them know who you are.
My name is Anthony Murray, and I am the retirement financial expert with World System Builder, World Financial Group. Matter of fact, I have an office in Rankin, Georgia called WFG Rankin Financial Center. And I'm here to help you understand how money works, especially when you're ready to retire. Now, look, we have a very special guest today. She is going to introduce herself in a few moments. We're going to bring her on. But she also is with this world renowned organization called World System Builder, World Financial Group. I happened to meet her at one of our functions. And listen, let me tell you something. If you need to understand how taxes and the small business come together, you need to be here. And if you know somebody that needs to understand how the small business and tax come together, you need to get them here. All right. So this is a powerful session today. You don't want to miss it. Don't get distracted. If you want to do anything, get on this phone and invite at least 5 people. At least 5. You can't think of 5, think of 1. If you could think of more than 1, think of 3, right? Get them here. This is going to be extremely, extremely, extremely important for the small business as we move into 2023. Okay, so we're going to be bringing our guests on in a few moments. But Flo, tell us a little bit about what you do.
Hey, man, Flo's in the house. I work right there alongside Anthony Murray there in the financial industry. I'm a financial educator. What I love doing is I love teaching people how to understand and make their money work for them. Because you know what? If you don't have that knowledge, people take advantage of your ignorance, and you're taking advantage of every day because you do not know. So, what better way to do something is to learn it? We offer free financial workshop classes. I'm gonna share that information, the link that you can log on and register Monday through Friday. We got them 2 o'clock, 8 o'clock, 10 p.m. So if that's not convenience, I don't know what is. Plus, you do this in the comfort of your home, and we have different instructors every time we come on. So don't miss out. Mad Flows in the house, ready to get started with this day right here. So let's go ahead and introduce our guest for today. And Anthony, let them know who we got.
Wonderful, wonderful. Well, this is Miss Amber Profitt. She is a tax strategist. She's going to tell us a little bit about her organization. She is also part of World Financial Group, World System Builder. She's located in the Maryland area. Am I right about that? In Maryland, right? All right.
Yes.
So listen, guys, y'all are in for a treat. Now, I know y'all have questions about taxes. We're going into tax season. All right. Tax season. So if you're not ready, all right, all I can say, you're either going to receive a refund or you're going to pay out some money. All right. So how are you going to avoid getting the audit and all that nice stuff that you don't want? Right. How is that going to happen? Hey, I want to encourage you. Y'all need to ask some questions. It's going to be serious. Amber, welcome in.
Hey, Anthony, how you doing? I haven't seen you in a while.
I know it's been too long, girl. It's been too long. Listen, are you going to the Trainers Academy?
If it's any time between now and the 17th, no. I have
No, it's going to be in November. November.
No, I can't. I haven't even looked at anything past what I'm currently doing right now. I'm dealing with
Okay.
the filing season, so I can't focus on anything else except for that.
Hey, tell us about this season. Tell us
Jesus.
about this season and about what you do, what your company does.
So, my company is Profitt Associates. We help with tax strategies and IRS representation. We work with a lot of high net worth clients. We do work with small businesses as well. Just pretty much educating clients and understanding what they're capable of doing, if they need to change the entity types, if we need to start moving monies in different places that are tax deferred or, tax free. So that's pretty much what I do in a nutshell. Oh, we prepare taxes too. Corporate taxes, trust and estate, and individual taxes, but more corporate than anything.
Okay. So, what are some of the things that the small business really get confused about when it comes to taxes?
Understanding how to register. I think that's the biggest downfall. A lot of people believe that the LLC is a protected entity, and it really isn't. It's not even considered an entity unless it's a partnership. So that's the biggest thing. Some people, they just take the chance on registering as an S Corp and have no clue why.
Wow.
There always have to be a reason why you need to make these changes, but they don't have a clue.
Wow. Hold on. Wait a minute. You need to back up on that. Okay. All right. Let's talk about this for a moment.
All right.
So a lot of people file LLC.
Mm-hmm.
All right. What is the advantage of filing an LLC? And what are the things people need to look at when they file so they don't fall into traps?
So it really all depends. That is a broad question, so I'll try to minimize it as much as I can.
Okay.
If you're a really small business, you're just starting off, you're not making much revenue, but you have more expenses than anything, and you haven't grown, maybe it's just you're only making maybe 30,000 profit, but you have operating expenses that exceed a certain amount, then I would say stay at an LLC. But when you start to grow and your revenues is up to 100 plus, I usually say 150 for clients. They need to move over to a corporation, because a lot of people don't realize that when you're an LLC and you make a net profit, there are two different types of taxes that you pay. You pay the regular income tax, whatever threshold you're in, and you pay this SE tax, which is self-employment tax.
Okay.
If you were a corporation, you would avoid self-employment tax and you'll only pay the actual tax rate that you're in.
All right.
Not many people know that. A lot of accountants don't explain it. They don't point those factors out, which is very important for just small business owners, because they never understand why they owe so much. They don't realize that additional amount comes from the self-employment tax.
Wow. All right, hold on. Wait a minute.
Okay.
So now you got your business tax and your self-employment tax.
No, so it's your regular income tax.
Income tax, right?
When you file, when you're a small business owner, you're in your LLC. You can be an LLC, DBA, or just a sole proprietor. All that stuff goes on your personal tax return. It's considered a pass-through entity, just like an S Corp. But the difference with the LLC is that you have self-employment tax.
Okay.
When do you pay that self-employment tax? At the end, or is
at the end? So when you file the return, it's incorporated into the total amount of what you would have normally owed if you had an S Corp in comparison to what you have an LLC and your 1040. So it can be quite expensive.
Percentage of an SE tax?
15.3% of the net profit on the corporate. On the Schedule C side.
Wow. All right, hold on a minute. Now let me. All right, you have your income tax. You have your self-employment tax.
Yeah, that's if you have
They're two different taxes.
Different tax, but it's all combusted in one in the tax return.
So if my tax bracket personal is 25%,
Mm-hmm.
and then I have to pay an additional 15% for SE.
For the net profit.
Okay.
Yep. Mm-hmm.
Right.
So it's net profit on the Schedule C. Always remember that in comparison to what you would normally pay. So say, for instance, I'm going to use an example. You have $30,000 in net profit, okay? But you had a W-2, which was about $150,000 plus any dividends or interest or whatever, which exceeds to $180,000. Depending on how you file, single, head of household, married, filing jointly or separately, that determines how much you'll pay. And the tax rates have changed, so I can't give you the full breakdown right now. It's too many to break down.
All right, wait a minute. You said tax rates have changed.
Yeah, the
Is
tax
that
rate
positive or negative?
It all depends. So I can't really say if it's a positive or negative. It depends on what you've done as the taxpayer. If you've taken advantage of any tax credits, if you've done any SEPs, which is self-employment pensions, solo 401ks, if you decided to pay yourself a salary outside of your business, so it really all depends. I couldn't really say specifically if it's a positive or a negative for someone.
All right.
Someone can have the same situation, but do things completely different, and it can be different. The situation can be completely different.
All right. Now, I'm going to ask you to be redundant a little bit, but talk about tax credits. Give me an idea of what a tax credit is, how someone could take out what they have to do to get tax credits. So how does tax credits work, in other words?
So there's so many tax credits. So like I said, I deal with a lot of high net worth clients.
Okay.
So I do a lot of tax planning for my high net worth clients to determine which tax credit would be best for them. A lot of my clients, we have been taking advantage of the gas and oil credit. No one really knows about that because I
never heard of that.
Right. So we take advantage of those gas and oil credits. You can be an employee working for someone as long as you fit into that tax bracket, or you can be a sole proprietor or a corporate entity owner or a trust owner. You have the ability to take advantage of the gas and oil tax credit.
All right. So what bracket is that?
So if you're married filing jointly, it's $300,000. If you're single or head of household, it's $250,000.
Okay.
Yes.
Question.
Mm-hmm.
Okay. I'm having solar added onto my home. I get a tax credit.
Mm-hmm.
So now that's on my personal home. That's not on my business.
Investment property.
So if I do it on my I will get a tax credit for that, but I cannot claim that for my business. But if I do have the solar added to my business, have that added, then I can take that as a tax credit for the business, correct?
Yeah, you can. Mm-hmm.
Okay.
Yep, but that is separate from what I mentioned as far as gas and oil.
Okay.
Yeah, so that's totally different. But that solar is definitely part of the tax credits. Fuel credits, they have different types of credits, so it really all depends. I don't really do a lot of the other credits, if you know what I mean, like the child tax credit, because of the type of clients that I do have. They don't qualify for these type of things. But yeah, it's just so many. Oh man, I mean, it's so many to discuss, and we will be here forever just talking about this stuff. But I just used the gas and oil because that's what I was finishing up with when you called me. I was finishing up.
Okay. Well, let me ask you, what are some tax credits, say for under 100,000, or most of our audience is going to be in the 50,000 to 100,000 range, or maybe from 30,000 to 100,000. I don't know. I'm just throwing out something general. What tax credits would you say fit in that category?
It really all depends on what the person has. I mean, if they have mortgage, of course, they get credits. If they have medical issues, that's a credit. So I can't really specify what tax credit someone would get because it's usually on a case-by-case basis.
Okay.
Can't really make those determinations.
All right. So now mortgages, when you say mortgage, you're referring to the interest.
Yeah.
Okay. Okay. All right. And so for someone who has a mortgage, they're in that category where where they are trying to write off something, because I understood. Well, it was mentioned to me that people can no longer write off. There's no longer tax credits for houses or for mortgages, but from what you're saying, there's still tax credits.
There's still tax credits, but you get the biggest outcome when it's over a certain amount that you paid in interest. For instance, if it's less than $23,000, you'll get a percentage, whereas if it's more than $23,000, you'll get a good chunk of that credit.
So it's working for the rich again.
Yeah, rich again, so it really all depends. That's why I say I can't really say, because it's a case by case situation. Okay. It's not, everybody doesn't have the same situation at all.
Okay.
What I can say, what I did want to speak on, because I have a lot of real estate people, and I don't know if there's real estate people on your platform, but even if, and for you, Mad Flow, for you and your primary residence, a lot of accountants do not explain the difference between capital expenditures and expenses. Have you ever heard of that?
Yeah. Do I understand it totally? I'll be honest.
I'm sure you don't. But that's totally fine. So you have an investment property and you write off the regular expenses, which is a normal thing. You write off those, utilities or any type of maintenance. That's normal. It goes on the Schedule C. The only thing that you can write off on your primary residence when you're living there is just your mortgage and your taxes, stuff like that, unless you sell. Now, you always have to keep a good amount of the expenses that you've put into the home. But capital expenditures are main large expenses like new roof, new floor, maybe some possible demolition. Those are important factors because that determines your capital gains. So you may just be breaking even.
Let me ask you a question. Okay, I just redid the kitchen because of the fact that I had damage in my kitchen.
Okay.
And that's my personal. So can that be like a write-off?
When you sell, yes.
Oh, only when I sell?
Only when you sell.
Not as I live in?
Not as you're living in there. So that is considered part of your capital expenditures. So any of the contractors that you may have, that's part of it. On top of the estimate, save those receipts. Those receipts are always important because you want to attach it to the tax return just in case they do try to come back. Not saying that they will, but you'd rather be safe than sorry. But yeah, so that's part of the capital expenditures for your primary residence if you sell, because people don't realize that when you sell your primary residence, you have the IRS believes they use the basis, which means whatever you purchased the home for. So say, for instance, you purchased a house for $100,000 and you sold it for $400,000. In the IRS mind, they believe that you received $300,000 of that money. They don't know the full breakdown of what you've expensed out while you live there. So this is where the capital expenditures flow for the primary residence. Okay.
Hey, let me ask you something, Amber. What are some of the tax credits that people in smaller categories, 50,000, under 100,000, that they overlook?
I don't know. Because it isn't a lot that is available to them, if that makes sense.
You said there's not a lot?
There isn't a lot available to them unless they've done things prior to.
Okay.
Like
what?
It's about 300 different tax credits. I cannot specify.
Wow.
Anything. So I can't really, that's why I said I can't really say. It's such a broad question. It really all depends on the person's circumstances and if they qualify for those things, or if they've invested in those things and they're able to get the credit based off of their investment. But I wouldn't technically know.
Okay. All right.
Okay.
So technically it's impossible at this point anyway, at this junction to say what credits a person could use because they're all individual cases.
Yeah, everybody's case is totally different. Some things may not pertain to another person. Some people file jointly, some people file separately. And if you, I do want to say this. There was another thing in regards to small business owners that are filing jointly. When you do file jointly and your spouse does not have the liability and you do, the accountant is supposed to file an injured spouse form for the spouse, just so they won't be responsible for your tax debt. Because if you don't, they will be responsible for your tax debt and they'll have the same issues as you.
Okay.
All right, the accountant should file a what?
Injured spouse form.
Okay.
Okay, so my husband, we do file jointly.
Mm-hmm.
So my husband is not, part of the business. His name is not on the business, but we still file jointly. So my accountant should be filing an injured spouse. What's that called? Injured
spouse form. So that takes the liability off of him. You guys still get the married filing joint credit because that's the lowest credit. If you do married filing separately, that's like you're filing single. But married filing joint is always suggested as long as you file an injured spouse form.
All right, so I got to remember that. Now, you talked about the capital expenditure. Because see, my daughter had just sold her house that she was in for 5 years, but she did a lot of improvements. And I bet you I can go back to her tax record, and that was not included. She sold it this year. She sold it in 2022. She filed for 2021, right? She just need to make sure she puts all of these capital expenses she did on her taxes for this year.
Right. So just know capital expenditures is also part of the HUD. So the first HUD when you purchased it and the second HUD when you sold it. There's only certain things that you can write off, but that's part of your capital expenditures. Okay.
I can let my daughter know this. So she sold her house this year. She can file it this coming year. The capital expenditure, she can file it this year.
Right, because you want to make sure your capital gains is as low as it's possible, because the IRS allows up to $250,000 of exclusion, meaning your total income that includes your wages, your business, and the sale. $250,000 if you're single, $500,000 if you're married. So if you exceed that, then you're capped at the capital gains at about 25%. So you want to make sure it's lower than what the IRS believes, because in their mind, like I said, they believe this is what you received. You know what I'm saying?
Wow. Okay. Wow. This is some good information. So now, I really like that you said about the injured spouse form. Doesn't mean that the spouse is injured. That's just a form that they have to file so that they don't be liable.
Right. They won't be liable for your responsibility. You guys still get the married filing joint credit, but she or he will not be responsible for your tax debt for that tax year. But they have to file it every single year, and it has to be attached to the tax return that you're filing it with. Okay. Wow. They have to go through a breakdown. It's a little extra work, but it's better to do it for them, because who really wants to be responsible for their spouse's debt?
Right. Yeah.
No one discusses that part. No one have that type of conversation. They only just file, and that's all they know. Well, I guess I'm responsible. You technically aren't, because you can do an injured spouse form. As long as your debt isn't exceeding their debt, then you should be fine.
All right. So you would file an injured spouse form if you're LLC, or even if you're not.
It doesn't matter. There's some people that don't take out enough in taxes.
Okay.
Just being a W-2 wage earner. So
Okay.
it really does it. You can, our tax system allows us to see who would be responsible. And then that's
Okay.
how we determine how we need to move next. If we need to fill out an injured spouse form, then that's what we'll do. But if their stuff is equal, then we won't.
Wow.
Okay.
Wow.
But usually
Okay.
when someone is a Schedule C, which a lot, I mean, we receive not Schedule Cs, we receive 1099s from WFG. And obviously we have to file the 1099 based
Right.
on whatever the profits we made. And if there's a net profit in the end, would your wife want to be responsible for your debt? Probably not.
Probably not. Probably not.
Right. So that's something to keep in mind.
Wow. Wow.
As you're talking, I'm informing my daughter because she's not able to get on the call.
Okay, no problem.
My lips moving, and I was not. You couldn't hear me. I'm on the cell phone talking to my daughter, get this information over to her. Trying to get
that's no problem. I mean, this is important things that the accountants does not discuss. And even if you are making $50,000 to $100,000, you may still have these issues in the long run. You may have been in your house for 20 plus years and you decide to sell. You know, that's a huge chunk of change right there.
Okay.
You don't want to be responsible for that huge debt.
Question. When someone sells a home, the profit that they make off of that, do they have to pay taxes on the money that they earn from their profit, from their home?
So that's what I was discussing. So that will, remember I said the IRS goes off the base of the home, which means what you purchased it for. If it was $100,000 and you sold it for $400,000, the IRS believes that you received $300,000, but you really didn't receive $300,000 because that money is being paid back for whatever you've invested into the property. So that's where the capital expenditures come. So that form is prepared on top of whatever the 1040 has, and that can be for an investment property, which would be a separate form in comparison to your primary residence. But the capital gains is all the same.
Oh, okay.
Okay.
Good to know. Good to know.
Well, I probably need to hire you for be my tax attorney. You know, man. Well, look, I'm not in the $1 million bracket yet. You know, you take a small fries.
Listen, you got offices and stuff.
Hey, Anthony, we just go set a goal. We're gonna make that 400,000 and call her.
You know what? It's very easy to get to the level that you choose to. It's much easier than it sounds because there's certain things that you can put in place and that will accumulate or accrue interest. And some people live off the interest of certain things that they've invested in.
That's true.
And still have their regular job. That's why I said the situation can be completely different. You can have your regular job and invested in something that you're living off.
Okay.
And it's your regular job could just be like your play money, you know? So it really depends on what you do. There's so many things that you can do. I always talk about opening up a trust for certain things, especially if you have several investment properties. Just to keep the liability off of you, irrevocable trust or revocable trust for primary residence. That's what I have. Just for security purpose, not security, but safety reasons, in case something happens. We just never know in this day and time. It's a little scary, so at least be prepared.
All right, let's go down that road. Let's talk about trust.
Okay.
Let's talk about trust. Let's talk about different types of trust. I don't know how many there are, and the advantages of the different trusts that you should discuss.
So I have a lot.
Let's talk about the irrevocable trust first.
So the irrevocable trust is protection of your. I have it on my primary residence, just in case something is to happen to me. My sister is the responsible party until my daughter turns 21. She's not 21 yet. So until then, nothing can change unless I make the change on my will.
Right.
Other than that, everything else stays the same. But investment properties, I always tell people to get a revocable trust because things change. Okay. We don't know. Everything is a little different than the norm. I have a trust in the state attorney, of course. But my biggest area is corporate, just so you know. I'm a corporate person, mainly corporate, but I know certain things that I've gotten for myself has benefited me tremendously. There's other things that you can do too, that my trust and estate attorney mentioned. If you have investment properties under you personally, you can make it seem as if you don't own them or they're not even around in your realm, even though you own them. But if in case you were in an accident and someone tries to sue you, a good attorney will look up and see what you own, and see everything that you own and try to go after everything that you own. There's some things that you can do to make it seem as if you don't own anything other than your primary residence.
Oh,
yeah.
Okay. All right. So
the trust attorney can tell you. I forget the name. Don't quote me. I forget the name of it. But there's something in particular that they do where they can remove you or hide you personally away from those properties as if you don't own it.
Okay. Now let me ask you something, because you said something that was very interesting. You have two different trusts. You have an irrevocable and a
corporate.
Yeah.
Okay.
Corporate trust.
All right. I never heard of the corporate trust.
That's for your businesses.
Mm-hmm.
And the irrevocable one is for
my primary.
Mm-hmm.
Okay. So I heard of revocable trust and irrevocable trust, but I never heard of the corporate trust.
Yeah, there's corporate trust. There's in a few of my clients, we have them get corporate trust because of the threshold that they're in. Anyone making over $1 million plus should consider getting a corporate trust.
Okay.
They should,
even if they're at 1099 like us.
If that 1099 says $1 million,
yes,
corporate. So here's the thing. Here's the thing, because a lot of business owners don't realize, when you get a 1099 like we do, right, I funnel the money through my company and pay myself a salary from that 1099, so I can offset the amount that 1099 says. I still have expenses on that 1099. And I pay myself more as a salary owner so I can lower my tax liability. But obviously, I do other things as well. So as a business owner, if you're receiving a certain amount, you can set up a salary for yourself. Pay yourself a W-2 wage earner. Unless you are in a partnership LLC, it is illegal to do it per the IRS. But anything else, corporate, C Corp, S Corp, single member LLC, like, or sole proprietor or whatever, you can pay yourself a salary from the monies that you receive from them. That's one way you can lower your liability, because you're already pre-taxing. Okay.
So
or
pay
you
myself. So pay myself.
Yes.
For my business.
Yeah. I'm an employee for my business.
The structure, how you set that structure up?
You can just be an LLC. And you can go through a payroll company, Paychecks, ADP. They set up all the stuff with the state, depending on where you are. And then you determine how much you want to pay yourself every month. Is it bi-weekly? Is it monthly? Or is it, every week?
And that's called what? Payroll?
Payroll.
You say something.
Just payroll.
Yeah, just payroll.
Where did I go through to get, you said something.
Oh, ADP, Paychecks.
ADP.
Or Paychecks.
Or Paychecks. Okay. And then they set that up for me so I can basically W-2 myself, pay myself monthly, weekly, whatever. Okay.
Yeah. Whatever you're comfortable with, you have to make sure that you're comfortable and you have the funds to do it. Because if you don't, that's another problem that you don't want to create. And that's why I said we do IRS representation. We have clients that have trust fund recovery issues, which are called payroll issues.
Okay.
Make sure you have to pay it. So whatever you are comfortable with, whatever you can pay, if it's $1,000 a month, just do it that way until you're ready to increase it.
Okay.
Okay.
Wow. So there's advantages, I'm sure. Of how much time do you have, Amber? I know.
It's Friday.
Okay.
Yeah, it's Friday and the hurricane's out there.
Yeah, are we supposed to be getting this dang on hurricane? I'm so pissed right now. I'm so
Well, look.
Where are you located?
Things to do, huh?
Where are you located?
In Maryland.
Maryland. Oh, my
So it's
sister.
coming up. They had a state of emergency in Virginia. I'm 15 minutes away from Virginia.
Okay.
I said, if that's the case, then it may be coming this way, and we're supposed to be getting heavy rain.
Wow.
I think the wind is supposed to be between 30 to 40 miles. I said, okay, I'll stay in the house. I was supposed to be a black tie event. It's Lord Jesus, but that's another story.
Yeah. They cried hurricane, and I tell you, when we had prayer, we watched that thing. It went out to Ocean and bypassed our area.
Really?
It went right to Charleston and going up the coast now. So
oh
I'm
wow,
not worried about it.
Lucky you. I'm jealous.
I
It hasn't
know
started raining yet, but I just bought some stuff just in case.
Yeah. Well, we bought stuff because the stores were just running out. And I said, look, I better buy some food now so I can have it for next week, because we don't know when those trucks are going to get back here. So now let me ask you something. The LLC should be set up at what stage in your business?
It can be set up at any stage,
regardless of the income.
Regardless of the income, it can be set up at, because if you have potential to grow, then you at least want to be set up in some way.
Okay.
But just to clear some things up, because I always mention LLC in the S Corp stuff. When you start making money, your LLC can be treated as an S Corp.
Okay.
So you can fill out a form with the IRS. It's called a 2553 form. And there's a specific code that you have to put on the top stating that you're doing a late election. You're requesting to be treated as an S Corp. The IRS will make those changes, and you'll be Anthony Murray, LLC, and you do an S Corp tax return.
All right. Oh, okay. Now, the advantages of that S Corp tax return are what?
As I mentioned before, I mean, so the S Corp, you have to pay yourself a salary. It is a requirement with the IRS.
Okay.
But there's certain tax benefits that you get as an S Corp that will help you in the long run. See, people don't realize when you have a self-employment pension or a solo 401k and you're an LLC, you can only write off a percentage of that amount.
Okay.
On your 1040. Whereas if you are an S Corp and you have a self-employment pension or a solo 401k that you prepared for that tax year, you're able to write off the full amount on that S. Okay?
What?
Yeah, keep that in mind.
All right.
Yeah. So those things are very important. People don't realize. See, I'm on the tax end, so I know what everything looks like on the tax end in comparison to someone being the financial advisor, and they don't understand what the impact is on the tax end. Yes, we can recommend these things, but if we miss certain things, then we only get a percentage of it. Keep that in mind. Okay. But also keep in mind, because it was funny, I spoke to another financial advisor yesterday. Actually, I'm trying to get a client squared away on some tax planning and stuff. And he had no clue that when you file an extension, that it allows you to extend out the time to fund your self-employment pension and solo 401k. So people that are filing their October tax returns has just funded their solo 401ks in September. So we can write it off for 2021.
I always extend my tax. I can never be on time. How long you been in business?
I've been in business for, it's going to be 7 years next year. And
you're perfection, girl. You're perfection.
Yeah. I have about 10, 11 years of experience so I'm an EA, just so you know. I'm an enroll agent before the IRS. I'm licensed with them. I do work throughout the U.S. I have clients in 19 states. I plan to get my Series 7. I made the decision, instead of doing a 6, I'm going to get the 7 instead. It just makes a lot of sense because my clients are all over.
All right.
So like I said, my experience in my company is almost 7 years.
Okay.
Almost 12 years in total.
12 years in total. Listen, ladies and gentlemen, those of you that are with us today, you know what? Shame on us. We didn't have more people, but there's going to be more people that's going to jump in throughout the week.
Mm-hmm.
And this is something that's extremely, extremely important for us business owners and people that are aspiring to become a business owner. Something that I did not look at, and you brought it up, which is valuable to me, is that I can just go ahead and do my LLC, get it done and over with. Because in my mindset, I was thinking, all right, when you reach a certain income level, LLC, you reach a certain income level, C Corp, S Corp,
No.
you know.
Don't do a C Corp yet.
Huh?
Don't do C Corp.
No.
I only recommend C Corp if you surpass $1 million.
Yeah, only $1 million. Yeah.
You remove
and
the
so
pass-through entity stuff. So just so you know, I don't know if you guys are familiar with pass-through taxes in comparison to just regular. Are you familiar with that?
Oh,
no, that's why we have you here.
Well, no, I mean, listen, I wasn't sure. Some advisors educate and some of them don't. So pass-through entity is, like I mentioned before, the LLCs, the partnership LLCs, and the S Corp. You receive a K-1 form from the partnership or the S Corp. The partnership or the S Corp goes on your personal tax return. That's the pass-through tax. LLC is the same thing, single member. But the C Corp does not have pass-through tax. And we always recommend, being that you are a corporate member, that you pay yourself a reasonable salary as a C Corp. And the C Corp is taxed differently from you personally. So the C Corp is double tax. However, it could be less tax than what you actually have on your 1040. So I'm going to use an example. I have a client that net profit $1 million, right? They net profit $1 million on their C Corp. That's $210,000 that they would owe because they have 21% flat rate. That doesn't move over to their personal tax return. That's what they have to pay on the C Corp, and that's it. And they only have to focus on their W-2. Whereas if you are an S Corp, you made $1 million. That $1 million goes onto your personal tax return, 1040, on top of your W-2. So say, for instance, you make $250,000 in your W-2. Now it looks like you made $1.2 million. You're at the highest tax rate, which is 37%.
wow.
So that's why we make those recommendations.
So as your income goes up, you need to be careful of how you're filing those taxes and how your organization is set up.
Yep, how you're registered, and make sure. And this is where corporate trusts come into play. You can start moving money in certain places. You can do a private family foundation to lower your tax bill at about 30%. So that $1 million is now $700,000. So now it's taxed at 21% on the $700,000, not the $1 million, because you kept $300 for yourself. So that's a complete wash. And then,
Go ahead, finish.
And then there's other benefits that you may have. Help me out, Anthony. There's some financial options that we have. For some reason, I'm drawing a blank.
All right. So there's a lot of benefits that we have, right?
Right.
There's a lot of benefits. But before we go that, let me just make sure I got this right, because I never heard of pass-through. And that is pass-through
entity. That's what it's called.
Pass-through
entity. So LLCs, partnership, and regular LLC and S Corp are considered pass-through entities.
Wow.
So when you start making a certain amount of money, then we move you to a different type of entity.
Okay. So when someone starts a business for tax purposes, they should open up an account in that business name?
Yeah, of course.
All right.
And make sure you have all your operational expenses separate from you personally.
What about
you get audited? The IRS, how are they going to differentiate your personal and your business stuff?
Okay. All right. So what about us 1099 folks? Like with WSB, WFG specifically, that we're 1099. Should we go ahead, open up business account, registered a business name, or? So
that's difficult because I was trying to get WFG to pay me through my company.
Yeah,
but they don't want to do that.
No.
So I
Okay.
said, okay, though, let me
go
be
to
the
your
creative
Social
Amber
Security
that I
number.
am. So I was like, okay, so this is where I pay myself a salary.
Uh-huh.
I include whatever monies that I receive, even though it's deposited in my personal account. I move that money into my company.
That's
I write
what
a
I
check
do.
for my personal, write it to my company, and when I get my check every month for my wages, it's included in there.
Yeah. That's the same thing I had to do because WP
Yeah.
does not. They said no, we don't take TINs.
Yeah, I don't know
Everything
why.
goes
I'm
on your
kind of
Social
upset
Security
about that
number.
because I have I have some big deals happening right now, and I don't want any trouble.
Yeah.
I know how the IRS works, and I'm the last person that can get in trouble.
So it goes to my personal account, and then I immediately transfer it into my business account, and then pull it out and pay whatever I need to pay.
So here's the thing: don't transfer it. Write a check.
Write a check.
Write a check to the business.
Okay.
As if you personally owe the business.
Okay. So
that way, it doesn't look like it doesn't look like there's additional income for the business. Does that make sense?
Okay.
Okay. So it won't look like it's what?
Additional
It
income.
looks like additional. It doesn't look like it is additional income.
Okay.
For your business.
Okay.
So I have my personal account. I write a check, Amber Profitt, to Profitt Associates. This is for what do I write? I write something in specific. I'll get that information to you, Miss Flo.
Okay.
But I write something.
I can do that through my bill pay because I pay all my checks on my
Yeah, you can do it through your bill pay. Write a check to your company.
To myself instead of transferring from my personal account into my business.
Right. But
Right.
But the good thing is you want to pay yourself an actual wage salary because that 1099 is taxed at that 15.3% or whatever the net profit is. So if you have expenses that may exceed, you've already paid yourself. Even though WFG paid you a certain way, you paid yourself the right way.
Okay. So pay myself, like I just did $2,700. I moved it from my personal to my business.
To your company.
And then I had another one that was $780. And I moved it from my personal, and this was from my rental properties.
Right. Well, your rental property is completely different from
that was from my pension. So my personal pension, I moved it from there to my business. And the only reason I did that really, I'll tell you why I did that.
Is different.
I'm trying to build my business credit. So I applied for a loan just recently. Okay. And it showed where 1 month I had $25,000 deposited. Another month I had $5,000 deposited. But August, I was missing August, and I did have a $10,000 deposit, but it went into my personal, and I never transferred into my business. And so what happened was, because they cannot show that I was at least having $5,000 every month for 3 months, I was declined. I was so upset.
Oh, that's upsetting. Well, I wouldn't consider that as income. Remember, I said the money that's coming from there is not technically income going into another account.
I know,
it's
but
only income going to you. But
the loan company looked at it as income because they wanted to see money moving.
Right.
So once they saw that, and they said, "You're good with these 2 months. We just need August." Where's the?
Well, yeah. So that situation, you should be okay. I'm talking about as far as WFG providing us our normal pays. And then even though we got it in our personal bank account, I wrote a check to my company to make sure they paid me my monthly salary. So I paid myself, but I paid myself with taxes taken out. So when I prepare my personal tax return, I still have to claim the 1099, but I've already pre-taxed. So I paid majority of the taxes on that 1099 with my additional expenses. Is that clear?
Yep. Yeah. Let me ask you something. 2 things. One, Sharon Brown has a question. If you set up a LLC, will you have to pay taxes on the LLC before making money?
No. The only tax that you would have to pay, depending on the state, is your annual property tax to keep the business open.
Okay.
So that can range between $250 to $300 annually. Other than that, no. And if there was no real,
$250 for what?
so
What was that again?
depending on the state that you registered, it can either be $250 or $300 to keep your business active. A lot of people don't know
keep
that.
the LLC active.
Yeah, to keep the LLC active.
Oh, okay. Yeah, ours is 100.
Well, you know, a lot of people used to open LLCs in Delaware.
You still have to pay the annual tax report.
Still got to pay, right?
You still have to pay. It just avoids the state tax. But that doesn't mean that you live there. That's not your domicile state. That may be your company's domicile state. But remember, I told you the pass-through entity, you live in, even though you registered in Delaware, you live in DC. You still have to pay that tax.
Okay.
Profitt. Question: is that your real name, or you made up that name, Profitt?
That's my real name.
That's
my real name. That's so
That's
funny.
your name.
You're in the right business. When we're doing taxes, and we have our regular tax account we had for many years, and they were doing our personal taxes for many years. Then we move over and open up a business, and we give these, now that same tax accountant is is doing our business taxes. Do you recommend that we research and make sure that this tax person, not just thinking that they know how to file an LLC, a corporate, S corp, paperwork, and all that stuff, or should all accountants know that automatically?
No, not all of them know automatically, because some people don't specialize in certain areas. Like I said, I specialize in corporate stuff. Anything corporate, I know how to handle. But anything like a state, I don't know it. But I have somebody that does.
Okay.
So
all I can say is the sister's bad. That sister got it going on. Hey, Sharon Brown has another question. So, can you open up an LLC in any state?
You can, but you have to remember you file the state tax where you live, because it's based on your domicile state. Your 1040 is.
You're not avoiding that tax. I don't care where you file it.
You can register it in a different state, or you can register in your same state. I would say register in the same state, just so you can avoid filing two different state tax returns.
Hold on, wait a minute.
One LLC in this, like if I have two different businesses.
Say that again.
Can I have more than one LLC?
Yeah. I always recommend anyone that has a lot of investment properties to LLC each one separately.
Okay, so I have 5 rental properties.
Absolutely.
So having 5 rental properties, I need an LLC each one of those separately.
I would recommend it because, like I said, God forbid something happens, a tenant falls down on one of your properties. Guess who's going after the rest of them?
So I wouldn't have to do a TIN number for each one, just an LLC.
The TIN number, you have to do a TIN number and an LLC. Yes.
Okay, so do a TIN number and an LLC for each separate property. Oh, okay.
And this is just for asset protection reasons, making sure if they fell on that unit, then let's just focus on that one because they don't need to know about the rest of the stuff, Wow. Whereas them finding out everything about you, now they're coming after all of your assets plus your primary.
And then I have to have a separate name, reserve a name for each one. So
it could be Mad Flow 1, Mad Flow 2, Mad Flow 3. It could be.
That's what I want to know. I can just
it could be.
I love it. I love it.
Okay, so I have one LLC for the financial business, but I don't have one for each one of my rental properties.
Yeah, so, I would, like I said, for protection reasons, you don't want, these tenants can be interesting. So I've heard.
Oh, they are very interesting.
So it's just better to just be protected on your end. I would say talk to a real estate attorney about that.
Okay, real estate attorney.
All right. Hey, folks, we got to get ready to wrap it up. I want to get some last. Huh?
I said I was on here too much. Did you guys have another guest?
No. Our show ends. We're only here an hour, and we try to close a few minutes early for credits and stuff like that. But anyway, I want to get some last minute thoughts, last minute comments from Miss Amber. But before you say anything, let me just say it was an honor and such a privilege to have someone of your status to come on this show. And this information I want to share, it's been extremely important and valuable. Even Sharon said, this information is so important, have her come on again. Well, listen, you know what? We love to do that at some point in the future. We're going into major tax season. And Amber, I know you are one busy woman. You have clients all over the country, all over. I see you with Amber Profitt Associates all over the country. I mean, I wouldn't be surprised if you end up with offices all over the country.
I like how my company is now. It's easier to manage. I don't have to go into an office space since COVID kind of like had us working from home. It's easier to maintain, and my staff, they do whatever needs to be done. But all you may see us with something big very soon. We just signed a contract with something. So.
All right. Well, wow. We've got to get back to this, and we're so thankful. Sharon Brown said, "Hey, if she has questions, how can she reach you?"
Can I leave something in the comments where?
Yeah, and I'll post it on. Let me put a banner up there.
Okay.
Go ahead and put it in chat, and I'll copy paste and put it on the banner.
Yeah, because we've got to run.
We've got 4 minutes. We've got 3 minutes.
Well, not according to my computer clock.
No, look at on the screen.
Oh, yeah. Okay. All right.
Yours.
All right.
Hold on, I'm coming. I'm just trying to put my information in.
All right, Sharon, we're going to put something up there for you and all those who's interested. I think we're going to put it in as a banner. Is that right?
Yeah, as soon as I get it, I'll go ahead and put it as a banner.
All right, sounds good.
Let me copy.
There you go.
I did my best.
All right. Hey, I tell you what, all we have to do is copy and paste. Copy and paste. Well, listen, close us out with some last comments. I mean, give us some last comments, Amber.
Last comments. I mean, I hope for everyone that's going into the new year that are looking to open up businesses, take the information that I've given you into consideration. Even with you not being a larger scale company, still take this information as much as you can. That way you'll know what you're looking for. You'll understand what self-employment tax are in comparison to pass-through entity tax. Hopefully I explained it as much as I could. And if you have questions, just email me or call my office.
Wow, that's powerful. Hey, listen, folks, we want to thank you for taking time to be with us today. My name is Anthony Murray, your aspiring retirement professional. And Matt Flo, take us away.
Hey, also let you guys know we on Roku TV now as well as YouTube. But this is Mad Flo, making a difference for life and others. I'm not crazy, but I am mad about making a difference for life and others through financial literacy. This is Mad Flo checking out, you guys. Thank you so much, Ms. Profitt. It was awesome. I'm calling you 301-798-4051. Let me write that number down.
You can call me anytime.
Okay.
All right, you guys. Yeah. Thanks again for having me. I appreciate you.
Okay. Wonderful.
Let me find the close out. All right, Anthony.